In today's weekend video, I'm going to review the zones inside of the Nasdaq that we've been monitoring for potential bounces. Now, since the video in which we established these zones, they have been hit twice, and we'll take a look at both of those times in today's video. If you haven't already seen the previous video in which we build out these Fibonacci-based ranges, or zones rather, I'd recommend watching that first. In that video, we break down a plan of action to take advantage of these two different zones, which can be boiled down into really two different steps. The first step is the Nasdaq must tag either one of our cluster zones. These cluster zones are derived from both Fibonacci extensions as well as retracements, and they're the places in which the most overlaps take place. So if price action hits that, that's our first sign that, hey, we want to pay attention. Now, once that happens, to try and take advantage of the actual bounce, we have two different tools at our disposal. The first is our Futures Volatility Box, in which we have 5 different models to try and take advantage of intraday moves. Or the second, if even those 5 models get taken out of play, we have our Stock Volatility Box's daily volatility box zones to try and take advantage inside of the QQQ ETF. Now, in both cases, you can trade this however you'd like, using either the Nasdaq futures or the QQQ ETF or some other method, either using options or whatever you prefer. But the overall idea here is we have two different sets of tools to try and take advantage of these zones. Now, the reason we use these tools is they give us an instant framework for the actual trade setup. That means things like entries, that means things like stops, and that means things like targets, which you'll see as we go through the actual examples here. Now, if we start by taking a look at the first bounce, that bounce came on December 3rd. Now, to cue this back up, if you did watch this video on December 2nd, that means the very next day, that first zone came into play. Now, to give you some context of what happened on December 3rd, this was a non-farm payroll Friday. On that particular Friday, we had a disappointing jobs report. Now, that disappointing jobs report meant volatility. And that volatility inside of the market meant a heavy morning sell-off. And that heavy morning sell-off, if we keep connecting the dots here, meant inside of our futures markets here, using even our most conservative futures volatility box models, that's our doomsday conservative models, price action inside of the Nasdaq continued to break outside of it. Now, for those of you that are either new to this channel, you don't know this terminology, this in layman's terms really means that there was a lot of selling inside of the Nasdaq, stuff we don't usually see. The Nasdaq was instantly taken out of play in the first 30 minutes after the market opened for any kind of futures trading, and that was a pretty big red flag that there's a good amount of volatility. Now that the futures volatility box models have been taken out of play, that means out of our two toolkits, we have one still remaining, which are our stock volatility box daily levels. Let's take a look to see what those look like. Now, here's what the QQQ looked like. I have both the aggressive and the conservative zones, and you'll see price action bounce from both of them. This first set of cloud are the aggressive zones, and then the second set of clouds are the conservative zones. And price action on December 3rd here falls really inside of the aggressive zones, pauses a little bit, even tags the conservative zone towards the end of the day. And then on Monday, we have a fairly nice rally. You'll see that right here on Monday's activity, I should say Monday and Tuesday, we have some pretty nice follow through. Monday is about a 2% move in the QQQ, and on Tuesday, that's about a 5% move, including the gap up higher, and this is again using the baseline QQQ. If you trade options or use some sort of a leveraged vehicle, even things like the Nasdaq futures, the micro futures, QQQ options, all of those meant that in both of these scenarios, you came out fairly nicely. And this overlap also happened inside of that same Fibonacci cluster. So that's what we're looking for. Bounce number 1, December 3rd, was that ideal bounce in which one of our two tools let us take advantage of those zones. Now, if we come in and take a look at bounce number 2, that happened fairly recently. That was this past Friday, December 17th. Now, inside of December 17th's activity, our futures models were very much in play, unlike that first bounce. Now, the thing that was different is even though they were in play, our models were not hit in terms of the price action we were looking for inside of our gray zones. In fact, the only trade that triggered real time was this guy right here, in which all of our trade rules were met. We had this short breach, but this was towards the edge of an hour. That then took us into a long opportunity. This was the only one that met all of our trade plan rules. This was still a pretty nice bounce, even though it doesn't look like it. In this trade, this was an active, valid trade. we were risking 47 points inside of the Nasdaq. That's about $940 on the full size contract or 94 on the micro contract to try and make that same 47 on the opposite side. So this was it in terms of your trade opportunity. $940 on that one trade. Only T1 was hit. Second contract taken out at break even, and we have yet to see what actually happens with our Sunday futures open. So now all of this begs the question, since we've had two different bounces, we've been able to take advantage of the fact that we've had these zones, we've had these two different bounces, both with the futures and the stock zones. What can we expect for this upcoming week? Now, in terms of what I particularly expect for that, if we come into our daily chart of the Nasdaq futures market, there's a few different clues that I think call out to me. The first clue, and the most obvious clue, is our market pulse has now turned red, and you can see that much more clearly here with the label, which says we're now entering a stage of deceleration. Now, if we come into our charts here, that deceleration would suggest we should continue to see more bearish activity inside of the Nasdaq, at least in the shorter term. That bearish activity could mean we go deeper inside of our first zone, or even break outside of that first zone and tag our second zone. So again, if you haven't seen that previous video, highly recommend watching that, as you have more specific price levels around what each of these zones encompasses. But that would be where I'm looking at the Nasdaq to go into this upcoming week. Keep in mind that major magnet level is that 15,000 area, so that's the one to really be aware of. But outside of that, we can take a look and let price action tell us what happens next week, and use both our Futures Volatility Box models to trade any zigzags along the way, along with our daily Stock Volatility Box models for the days in which the Nasdaq has extreme selling, or in the other case, extreme rallies as well. I hope you found this video to be helpful to the follow-up to our previous Nasdaq zones video. Take care, everyone. Good luck trading, and we'll see you in our next update.